Hey traders, welcome back. Today we're diving deep into one of the most powerful and misunderstood concepts in smart money trading, the fair value gap, or FVG. By the end of this video, you'll understand exactly what a fair value gap is, why it forms, how institutions use it, and how you can trade it, even with zero indicators, using just pure price action. Let's get started. What is a fair value gap? A fair value gap is a price imbalance on the chart. It shows an area where the market moved too fast in one direction without giving the opposite side a chance to trade. Think of it like this. Imagine price explodes upwards. Buyers were so aggressive, price skipped over certain levels without letting sellers trade back. That creates an imbalance. That gap between candles is the fair value gap. In simple words, it's a price area where value was not exchanged fairly between buyers and sellers. Why is it important? Fair value gaps matter because smart money, like institutions and banks, often return to these gaps. Why? Because they likely have unfilled orders in those zones, or they want to rebalance price to fill the gap before continuing the trend. That's why FVGs are often great areas to watch for pullbacks, reversals, or even sniper entries. How do you identify a fair value gap? You don't need any indicators. You just need to know what to look for in the candlesticks. Here's how to spot a fair value gap. Step 1. Look at 3 consecutive candles. Step 2. You want to see a large momentum candle in the middle. Step 3. If the wick of the first and third candles do not overlap, you've found a fair value gap. Let me break it down. Candle 1. Let's say it's a bullish candle. Candle 2. A large bullish candle with strong body. Candle 3. Another bullish or neutral candle. Now look at the high of candle 1 and the low of candle 3. If there's a price gap between those 2 points, that's your fair value gap. This means price moved so fast it skipped over that area. Same idea in reverse for bearish FVG. Candle 1, bearish. Candle 2, big bearish candle. Candle 3, bearish or neutral. If the low of candle 1 and high of candle 3 do not overlap, you've got a bearish FVG. Draw a box from the body or wick of that gap. That becomes your area of interest. What timeframes to use? Fair value gaps appear on all timeframes, but here's how smart traders use them. Use higher timeframes like the 4-hour or daily to spot strong FVG zones. Drop down to the 15-minute or 5-minute charts to find confirmation entries. This helps avoid fakeouts and increases the chance of precision. Why does the market return to fair value gaps? Institutional traders like to fill imbalances. When price moves away too quickly, there are often unfilled orders or missing volume. The market will usually come back to fill this gap before resuming in the same direction. That's why you often see price shoot up, then return to the fair value gap, then continue upward. This gives you an ideal pullback entry. The FVG acts like a magnet, drawing price back before moving again. Bullish FVG example. Let's say price is trending up. You see? First candle, small bullish. Second candle, large bullish momentum candle. Third candle, small bullish. The second candle pushes price up so strongly, it leaves a gap between the high of candle 1 and the low of candle 3. That's your fair value gap. Now what? Wait for price to pull back into that FVG zone. When it enters the gap and shows rejection or a change of character on lower time frame, that's your entry signal. You place stop below the zone and target the next high or structure level. Bearish FVG example price is in a downtrend. You spot first candle, small bearish. Second candle, big bearish drop. Third candle, another bearish candle. The gap between the low of the first candle and the high of the third candle doesn't overlap. That's your bearish FVG. Price pulls back, fills the FVG, then drops again. You use that pullback for your short entry. When to avoid FVG trades. Not all fair value gaps are trade-worthy. Avoid these. FVGs in consolidation, FVGs against higher timeframe trend, FVGs with no structure break nearby, FVGs that have already been filled before only trade, FVGs that come after a strong structure break or in clear trend continuation. FVG versus order block. What's the difference? This is a common question. Fair value gap is a price imbalance, a skipped price zone. Order block is the last institutional candle before a move. FVG is more about imbalance. Order block is about origin of intent. Often they overlap. A good confluence setup is when both appear in the same area. Now let's talk entries. How to trade a fair value gap. Entry setup. Here's a step-by-step breakdown. Start on 4-hour or 1-hour chart. Find a large momentum candle with FVG. Mark the FVG zone. Wait for price to return to the gap. Drop to 15-minute or 5-minute chart. Look for confirmation, rejection candle, liquidity sweep, change of character, enter with stop beyond the gap, target the next liquidity or structural level. This method is used by smart money traders to catch clean, low-risk entries. Full FVG entry. Checklist strong momentum move, clean 3-candle formation, no wick overlap equals gap confirmed, near structure break or key level, aligns with higher timeframe bias, price returning to fill it, confirmation before entry. If all the above are checked, that's a solid setup. Extra tip. Use FVGs in ranges. Fair value gaps also work inside ranges. Price often sweeps liquidity at one side of the range, leaves a fair value gap, then moves in the opposite direction. Watch for FVGs right after a fakeout. They often give you a safe reversal zone. Real-world practice method. If you're new, here's how to practice FVGs. Open TradingView, pick any clean chart, like EURUSD or NAS 100. Go to the 15-minute time frame, scroll back and look for 3-candle FVGs. Mark them and see how price reacted when it came back. Do this for 20 to 30 setups. It will train your eyes and build trust in the pattern. Recap. What you learned about fair value gaps. Fair value gaps are price imbalances created by aggressive moves. They show where price skipped orders and often return later. FVGs come from 3-candle patterns where wicks do not overlap. Trade them only with confirmation. Combine with change of character, structure, and higher timeframe bias. Use them for entries after pullbacks, breakouts, or liquidity sweeps. Backtest regularly to build your edge. Final thoughts: fair value. Gaps are not just another smart money concept, they're a window into how the market really works. They show urgency, imbalance, and institutional footprints. If you master how to use them properly, they can give you sniper-level entries with low risk and high reward. Thanks for watching. Let me know in the comments if you want the next video on order blocks, liquidity sweeps, or how to combine FVGs with change of character for powerful setups. Don't forget to like, subscribe, and turn on notifications. Smart Money education continues in the next episode.